Good morning, everyone. Are you hearing me? You folks, are you hearing me? Somebody respond, please. Somebody respond, please.
Yes, sir.
Okay, good. Thank you very much for responding. Now, this session will be recorded today. So you'll have this to look back on, and it's currently being recorded now. You have to look back on. You'll have to look back on later on down the road when the time is right. I'm going to upload the file for today, and then I will
Where is it now? Everybody hearing me? Somebody answer, please. What? Why then?
Yes, sir. We are here. Yeah.
Yeah, see the screen? Oh, yeah, see on the screen.
Yeah, scroll through this one.
Oh, yeah, see. You see me? I scroll through.
Yeah.
All right. By the way, can you remember what did you do the last time? Can you remember, please?
So remember me did go. But we that do something we that look on the tables.
Show me
With
anybody.
some I don't know, I'm gonna call her.
No man, this is financial management, you know, this is financial accounting too.
Oh, me never had that one day. Let me.
Ocean,
Yo.
where did you reach last time? Remind me, please.
What that? Management?
Yeah, financial management. Where did you last time?
Couple. You gotta tell what me have, you know.
Yeah, tell me.
I think we have unit 1 and unit 2. I want something in financing decision. I know which one that fall under.
Okay,
And
unit.
something about ICTs and financial management. Them there we have. So
All
unit
right.
1, unit 2, and
Let me say unit 1 finished. Unit 1 finished then, man. Unit 1 finished. So we'll go to unit 2 now. We did start unit 2, but we don't finish yet. You understand?
Yeah. So I know you understand the course out there, you know?
You know, man, I'm not joke with thing, man. Relax, man. I'm not joke with thing, man. I'm not joke with thing.
So yes, sorry, the unit 2?
Yes.
So sorry, wait, question. This something about financing decision. That come under which unit?
Huh?
Which unit that come under?
Unit 1.
Financing.
Unit 1.
And the ICTs and financial management are unit 1?
Yeah, man.
I just want to put them in order. Yes, the unit 2 thing there.
What are you seeing on your screen now?
I see not yet.
Please move. Zoom share. Are you seeing this now?
Where I see anything there. You can't see it like it anyhow. What is the name again?
Folder.
Yeah, folder thing there.
White part. Share.
Oof, and
No, understand why it's not sure. And tell me to use that part. Yes. Okay. Give me a minute. Give me 1 minute. 1 minute. At least. Little pan share. Okay. You see it? Are you seeing on the screen now? What are you seeing on the screen? What are you seeing now? Hello?
See unit 2 something.
All right, good. Nice. Thank you very much. I was trying to just make sure everything is intact, you know. As I said before, that this we are recording. We are recording this session. So just let's continue. I just go now. So we're going to look at financial market and instruments now. I think we have gone through this section before already, but we're going to go back to it again. Money. Let me check some in the participant section. Everybody come in. Where is what's your name? Where is Miss
Brown.
where's Madam Miriam? Charmian.
So Charmian, so she think at 8 o'clock class, and
Who's
she's on her
Charmian?
way from town, so she not gonna be here.
Mm-mm. All right.
What is the left out here for? Me here.
Give me a minute, please, and the folks. Yes, sorry about that. I'm back on here now. So monetary policy is the macroeconomic policy laid down by central bank. It involves management of money supply and interest rate, and is the demand side economic policy used by government of a country to achieve macroeconomic objectives like inflation, consumption, growth, and liquidity. Example of monetary policy include in India, monetary policies of the Reserve Bank of Jamaica of India is aimed at managing the quantity of money in order to meet the requirements of different sectors of the economy and to increase the pace of economic growth. Macroeconomic factors now, fiscal policy is a collective term for taxing and spending actions of governments. In the United States, the national fiscal policy is determined by the executive and legislative branches of the government as well. If a government believes there is not enough business activity in an economy, let's continue. Look at fiscal now. So we look at monetary policy a while ago, right? Monetary policy is the what? Macroeconomic policy laid down by central bank. This involves management of money supply and interest rate, and is the demand side economic policy used by the government of a country to achieve macroeconomic objectives like inflation, consumption, growth, and liquidity. And we look at fiscal policy now. Fiscal policy is the collective term for the taxing and spending actions of governments. In the United States, the national fiscal policy is determined by the executive and legislative branches of the government. All right. Let me into folks. Back in business now. All right, so fiscal policy, as I said before, is the collective term of the taxing and spending actions of governments, right? In the United States, the national fiscal policy is determined by the executive and legislative branches of the government. All right. Macroeconomic factors containing fiscal. If a government believes there is not enough business activity in an economy, it can increase the amount of money it spends, often referred to as stimulus spending. All right. If there are not enough tax receipts to pay for the spending increases, governments borrow money by issuing debt securities such as government bonds, and in the process accumulate debt. This is referred to as deficit spending. All right, so yeah, we call stimulus spending and have what? Deficit spending, right? Good. So again, the government believes there's not enough business activity in an economy. It can increase the amount of money spent, often referred to as stimulus spending. If there are not enough tax receipts to pay for the spending increases, governments borrow money by issuing debt securities such as government bonds, and in the process accumulate debt. This is referred to as deficit spending. All right. Give me a minute, gentle folks. I am back, gentle folks. I am back. Why this is not? Everybody hearing me? All right. So as I was saying, fiscal. If a government if a government believes there is not enough business activity in an economy, it can increase the amount of money it spends, often referred to as stimulus spending, right? If there are not enough tax receipts to pay for the spending increases, governments meaning and tax receipts meaning tax revenue, because government earn revenue by through taxes. As you should all know by now. All right. Um, so it is if there are not enough tax receipts to pay for the spending increases, governments borrow money by issuing debt securities such as government bonds, and in the process accumulate debt, is referred to as deficit spending. Now we look at exchange rate now. Exchange rate, no. A fixed exchange rate is a regime applied by a fixed exchange rate is a regime applied by a country whereby the government or central bank ties the official exchange rate to another country's currency or the price of gold. All right. Go again. A fixed exchange rate is a regime applied by minute, folks. Give me 1 minute, please. 1 minute. 1 minute. We'll take a 5 minute break now. Yeah? 5 minute break. Give me a minute, please. Don't move. Just give me a minute. I'm back then, the folks. You have to minute when the time runs out, please log in back here. Anyways, a fixed exchange rate is a regime applied by a country whereby the government or the central bank ties the official exchange rate to the other to another country's currency or price of goods. The purpose of a fixed exchange rate system is to keep a currency's value within a narrow band. All right. Good. Fixed exchange rates provide greater certainty for exporters and importers. Fixed rates also helps the government maintain low inflation, which in the long run keeps interest rates down and stimulates trade and investments. All right. Interest rates, no. Interest rates is the amount charged expressed as as a percentage of principal by a lender to a borrower for the use of assets. Interest rates are typically noted on an annual basis, known as the annual percentage rate. Interest rate is the amount charged expressed as a percentage of principal by a lender to a borrower for the use of assets, right? Interest rates are typically noted on an annual basis, known as the annual percentage rate. The asset borrowed could include cash, consumer goods, and large assets such as a vehicle or a building. We got some organ. So like, all right, let's continue. Now we'll look at financial. So now we look at the macroeconomic factors a while ago, monetary policy, fiscal policy, interest rate, and exchange rates. Please know these things, please. All right, read them over for yourself. Okay. We look at financial markets now. Now, financial markets are markets that bring together people and organizations needing money with those having surplus funds. Again, so financial markets, they serve purpose of bringing together people and organizations needing money with those having surplus funds. All right. Financial markets now serve 6 basic functions. All right. Financial markets serve 6 basic functions. These functions include, are briefly said below, they include 1, borrowing and lending. Right. Financial markets permit the transfer of funds from one agent to another for either investment or consumption purposes. Right. Price determination. Financial markets provide vehicles by which vehicles are set both for newly issued financial assets and for the existing stock of financial assets as well. Information aggregation and coordination. That's the next purpose. Financial markets act as collectors and aggregators of information about financial asset values and the flow of funds from lenders to borrowers. All right. So first one is borrowing and lending, then you have price determination, and you have information aggregation and coordination. Financial markets act as collectors and aggregators of information about financial asset values and the flow of funds from lenders to borrowers. Yeah, risk sharing. Financial markets allow a transfer of risk from those who undertake investments to those who provide funds for those investments. All right? Financial markets allow a transfer of risk from those who undertake investments to those who provide funds for those investments. Then, liquidity. Financial markets provide to holders of financial assets with a chance to resell or liquidate these assets. Those who have stocks and bonds. And the last one, next one is efficiency. Last one, right? Efficiency. Financial markets reduce transaction costs and information costs as well. Now we look at the determinants of market interest rates now. In general, the quoted or nominal interest rate on a debt security labeled R is composed of a real risk-free rate, right? Which is R star plus several premiums that reflect inflation and the security's risks, its liquidity or marketability, and the years of its maturity. Quoted interest rate is R equal what? Real risk-free rate plus inflation premium. All of these terms you will see later on as we go along in the study. IP plus DRP plus LP plus MRP. And like I said before a while ago, all of these you will see as we go through this course. So you might want to know what IRP mean, DRP mean. IP mean inflation premium. DRP something different, but you will see them as we go along, right? Good. Now the quoted or nominal rate of interest. So R equal to what? Quoted or nominal rate of interest on a given security. I'm going to mention the other ones as well for you because I don't want you to go away and say, sir, never tell me this, even though I told you before that I will be going through them later on, but it might be, you can research them for yourself, you know. All right, our time has expired. So we're going to log out and log in back. All right, folks? Okay. So log in and log in back, please. Rejoin the meeting shortly. And I'm going to move to anything else before I rejoin the meeting. So you can re-log in shortly. Remember to what? Re-log in shortly, please. Because time has expired.